Well, it's 12 o'clock and good afternoon. Welcome to another installment of our ongoing nonprofit leadership and engagement education series. I am Joanne Nazer, Manager of Nonprofit Leadership and Engagement at the Washington County Community Foundation. Thank you for joining us today to learn from our content expert about compilations, reviews, audits, and what is right for your organization. This session is being recorded and will be posted along with a slide deck to the Washington County Community Foundation website under Grant Seekers Nonprofit Resources in a few days. During the presentation, we ask you that you be mindful of others and please keep yourself muted. This will reduce background noise during the live session as well as the recording. If you have any questions during the presentation, you may enter those in the chat. Time permitting, we will also have a question and answer session at the end of the presentation, or follow-up questions after today's sessions may be emailed to the foundation at allocations@wccf.net. Our content expert for today's session is Gary Kissinger, Certified Public Accountant. Gary is a shareholder in Palermo Kissinger and Associates. Gary joined the firm after graduating with a degree in accounting from Washington and Jefferson College in 1988. I'm an alumna too, Gary.
Yep.
He has over 30 years of experience working with local businesses, providing tax, accounting, and consulting services. In addition, Gary oversees the firm's quality control and each of the firm's audit engagements, thereby developing a specialty in audits of nonprofit organizations and local governments. Professionally, Gary is a member of the American Institute of Certified Public Accountants and the Pennsylvania Institute of Certified Public Accountants. He is the treasurer of the United Way of Washington County and a member of the Finance Committee Council of the Holy Child Church in Bridgeville. He resides in Upper St. Clair with his wife, Amy, and sons. It is my great pleasure to introduce you to Gary.
Thanks, Joanne. I really do appreciate it. And I appreciate the opportunity that the Community Foundation of Washington County has provided to talk about compilations, reviews, and audits. You know, when Joanne asked me to present this, I said, well, it's not the most exciting topic, but I'll see what I can do. But I appreciate all the information about my background, just a little bit more information about my firm. We have a staff of 12. We have 6 CPAs on staff. We represent about 40 nonprofits annually, whether it's doing audit work, review work, compilations, or just simply doing the 990s for the organizations. My firm participates in the peer review program with the AICPA, and that permits us to do compilations, reviews, and audits of nonprofits. CPAs are required to be part of the peer review program if they want to do that type of work. So talking about determining if a compilation review or an audit engagement is required, the first step would be, what are the external requirements? And in the Commonwealth of Pennsylvania, the Bureau of Charitable Organizations provides those requirements. And I'm not sure if we have the screen shares, correct, Joanne? Yes. So as you can see, the Commonwealth of PA, the Bureau of Charitable Organizations, provides these thresholds. So gross contributions of $25,000 to $100,000 requires an organization to either have internally prepared a compilation, a review, or an audit. From $100,000 to $250,000, it's a compilation, a review, or an audit. $250,000 to $750,000, review or an audit, and over $750,000, it's an audit. So the question then is, what does a gross annual contribution represent? And the key point there is looking at the 990, they identify it as all the items that are under the contributions, gifts, and grants sections of the 990 that's prepared, excluding government grants. So an organization receives a significant amount of government grants, but it doesn't receive money from the public. It may not be required to have an audit under the Bureau of Charitable Organizations, but it may be required to have an audit from the funding source, the government funding source. But also included in the calculation is down on 8A of the 990, the gross income from fundraising events, and also gross income from gaming events. That's important because a lot of organizations have a significant amount of fundraising activity, but also have special events that have a large gross volume number, even if the net fundraising number isn't as significant. So it's included in that calculation as shown on 8A and 8B, 9A of the 990. And it's part of the calculation of what type of engagement is required. So those are the external restrictions and requirements from the PA Bureau of Charitable Organizations. But also you may have other restrictions and requirements by your government funding sources. For instance, if you have a program that has a grant from the county or the state, in the grant contract, it's very likely that they'll have a requirement for you to have a compilation, a review, or an audit. Another circumstance would be if you have a grant from a foundation. And a lot of times there's a grant, there's a contract, a foundation grant would have a requirement for you to have an audit or a review done, at least to even apply for the grant. Another instance would be if a bank requires you to have an audit or a review done based on the loan documents. But it's important to note that those could be negotiable, and it's preferable that you negotiate that before the loan document's created. Therefore you can determine what type of engagement's needed ahead of time. So in order to avoid having to have an engagement that's larger than what the organization should have, I think a key thing to do would be to take a look at also have a compilation, the different types of reports that the organization would issue. So for example, I have a sample of a compilation report. And what exactly is a compilation? So a compilation is basically taking the financial information from the organization and putting it in a format of a financial statement. And a couple key items to take a look at on the compilation report would be we do not audit or review the financial statements. It provides no assurance on the financial statements. So accordingly, we do not express an opinion, a conclusion, nor provide any form of assurance on the financial statements. So that is the lowest level of service that a CPA could provide. The next step would be to determine whether or not you are on a cash basis of accounting or on an accrual basis of accounting. Yeah, on an accrual basis of accounting, all the assets, liabilities are recorded on the balance sheet, including receivables, payables, accrued liabilities, rate of use assets, and things of that nature. On a cash basis of accounting, it's really just only the cash, the fixed assets, the long-term debts presented on the balance sheet. And for small organizations, cash basis of accounting is appropriate and often used, but on a little bit larger organizations, accrual basis is the more accurate and appropriate method. And accrual basis of accounting is the generally accepted method of accounting. So it records all the receivables, payables, and liabilities, and it recognizes the revenues as it's earned and expenses as it's paid, as opposed to the cash basis of accounting that recognizes expenses as they're paid and revenue as it's collected. So there are other factors that the organization may factor in whether or not to do an audit or review or a compilation. A lot of times the bylaws of the organization dictate, whether you should also have an audit or review. But the board of the directors may also require an audit or review despite the BCO thresholds. And some of the factors that warrant the board's consideration of a step up from a compilation to a review or an audit would be if the organization, for instance, doesn't have a significant amount of segregation of duties, and it relies on the executive director to perform multiple functions. Another factor would be if a fiduciary or a trustee of the organization maintains client funds and collects funds and passes it on to others. And therefore, the organization may feel it's necessary, despite the thresholds that the BCO provide, to also require an audit to be done. An organization may receive a significant amount of restrictions, donor restricted money that's required to be used for the purposes of a designated purpose. And that's another reason why an audit might be performed if it isn't, even though you haven't met the threshold of having an audit or a review at the level of at the BCO thresholds. If the organization has multiple programs in which the indirect costs, such as admin costs or occupancy costs, are allocated, that might be another factor that would dictate the board to ask that an audit or review be done despite the thresholds. Another example would be if you have a significant amount of high-profile special event revenue and that supports the public. So that might be an instance where, even though that you don't have a threshold over the 750,000 threshold, it may be important for the organization to consider to have an audit done. But a key point there would be that the controls need to be in place for the special event for allow it to be auditable. I've had examples in the past where organizations have come to me after the fact and asked us if we'd be able to do an audit of a small organization, and that organization had significant fundraising activity, but there weren't necessarily controls in place during that period of time, and therefore it made it very difficult to audit in those circumstances. Discussions of just to have a discussion about whether or not to use accrual or cash basis of accounting. Accrual basis of accounting is a more accurate method of accounting. Cash basis is used by a lot of small organizations, and it's acceptable for you to do an audit or a review on a cash basis of accounting, but the key factors would be: do you have a significant amount of payables at the end of the year? Do you have a significant amount of receivables? Do you have a long-term debt? If you have those kind of factors, it's probably advisable that you would use the accrual basis of accounting. If your balance sheet simply consists of what's in the bank account, cash basis of accounting is the most appropriate method to use. When we look back at the BCO requirements related to the thresholds, the first threshold that you see is internally prepared financial statements. So internally prepared financial statements are simply a balance sheet and profit and loss statement that's printed from the organization's accounting software. A set of financial statements in a nonprofit organization format aren't prepared, and that's the lowest level. So you don't necessarily even need, you don't need a CPA firm to provide internally prepared financial statements. And that threshold goes up to about $100,000. But over that, a compilation is the next engagement. And it could either be, like I mentioned, on a cash basis or accrual basis of accounting. The CPA doesn't need to be independent, which is also important to note, because and it may be useful if accounting cleanup work is needed, and the CPA can perform that service. If accounting cleanup is needed with a nonprofit organization and the CPA has to do that cleanup work, he's no longer independent, he or she's no longer independent, and therefore a review or an audit wouldn't be is an engagement that CPA would be able to do. They'd have to employ or contract with another firm to do some of the cleanup work before we would actually be able to do the audit. Talking about a review engagement, a review engagement is an engagement that would be required if the organization received over $250,000 of contributions and other sources of support from the community. So a review engagement provides a limited assurance, and here's an example of a review engagement report.
Gary, we also have a question in the chat. I didn't know if you want to address that now. It was about compilations. Should I read it for you?
Yeah, absolutely, Joanne.
So to clarify, even if an organization experiences less than 1,000 in revenue each year, including through fundraising, a foundation or other granting entity can still require us to complete an external audit by a firm in order to apply for a grant, despite not reaching the threshold according to the BCO guidelines.
Yeah, absolutely. If you have a contract that has a requirement for you to have a certain type of engagement, you would have to complete that type of engagement to comply with the contract. The Bureau of Charitable Organizations, is a specific threshold for that organization, but there's many instances in which, a different type of engagement will be required by a different source. Another example would be if like I mentioned, if you have a line of credit or a bank loan that has a contract that says that you have to have that type of engagement done, despite the threshold of what the BCO is requiring, you would have to comply with that as well. So this is an example of a review report, and the key items in this review report would be that based on our review, we're not aware of any material modifications that would be required in order for them to be in accordance with generally accepted accounting principle. So what is a review? So a review is when a CPA gains an understanding of an organization's accounting practices, the industry it operates in, and its business activities. The CPA conducts inquiries and performs analytical procedures, plus additional procedures if the information appears to be questionable. Analytical procedures are evaluating plausible relationships between both financial and non-financial data. So as an example, a CPA would go in and do a comparison of current year and prior year and explain the differences. Another example would be budget versus actual comparisons and explaining the differences. Also, a CPA would go in, join in a review engagement, and create predictive tests. For example, using units of service times rates and comparing them to billings. So you gain an understanding of the organization from that standpoint, and it allows you to conduct your engagement and provide a conclusion whether the financial statements are not materially misstated. So it does provide limited assurance, and like I said, it's the next step up from the compilation, but it's not as comprehensive as an audit. The disclosures in the financial statements all have to be included, and GAAP financial statements have a lot of financial statement disclosures, including footnotes that go over multiple different things in the financial statements, including the liquidity of the organization, including details of long-term debt, including details of your fixed assets and things of that nature. Unlike an audit, there's not a requirement for a CPA to obtain an understanding of internal control or assess risk or assess fraud risk in a review, but there is such a requirement under an audit. In a review engagement, the organization would be required to sign a letter of representation identifying the fact that they provided you with all the information that's needed in the review and answered all the questions truthfully. So once again, the CPA does need to be independent to do a review engagement, So if cleanup work is needed, the CPA can't do that. Another accountant would have to clean that up before we come in and do the engagement. What I mean by that is, you know, in a perfect world, we walk in as a CPA and are provided with a trial balance that has all the accounts tied down, and we do our work to determine if those financial statements are materially misstated, and if there's a lot of adjustments that are needed, we can lose our independence by doing that accounting cleanup work. So that it's important to note that we should be getting information that is after all the adjustments, all the reconciliations are occurring. On a review engagement, if we can take a look at an example of a review engagement letter, the key words in an audit engagement are report are the financial statements referred to above present fairly in all material respects. So the opinion paragraph is the front and center at the beginning of the report, and those are the key words that the financial statements present fairly. So we conduct our audit, provide an opinion on your financial statements, and that's part of the basis for, and also part of the report is what our basis for our audit opinion is. And we gather enough evidence to provide us with that basis for the opinion. And the sentence that we believe that the audit evidence we've obtained is sufficient and appropriate to provide a basis for audit opinion is the conclusion based on the work that we do as CPAs to get it to that point. But management has a responsibility for the financial statement, and the financial statement responsibilities start with the fact that you provide the CPA with a trial balance that has all the assets, liabilities, revenues, and expenses, and you provide that information in a format that allows us to conduct the audit. Often, majority of the organizations are using adequate accounting software that provides that starting point of the audit. But in many instances, in some instances on small organization, it's basically just the activity through the bank account, and then you have to kind of recreate that trial balance. That's where it's important to provide adequate and accurate information to the CPA as he starts the audit process. The paragraph on the independent auditor's report related to auditor's responsibility is has a couple key things. Once again, we are providing as a CPA reasonable assurance. Reasonable assurance is a high level of assurance, but it's not absolute assurance. And what we mean by that is that there's not a guarantee that the audit conducted in accordance with generally accepted auditing standards will detect all the material misstatements. The risk of not detecting misstatements, could be possible because there could be fraud within the organization. There could be errors within the organization, and the audit process is intended to provide reasonable assurance, but not absolute assurance. However, also part of the process is that CPA is required to maintain professional skepticism throughout the audit and identify and assess audit risk and fraud risk. Part of the process would be to have discussions with members of management about the process, learn the process, ask them about the risk of potential fraud and misappropriation of funds, as well as the risk of material misstatements. So we do inquiries to determine what areas that we should audit and where to spend our time during the audit process. Areas of risk in most nonprofits include the billing process, the bill paying process, the payroll process, but also gaining an understanding in internal control, but not necessarily providing an opinion on internal control. We evaluate the accounting policies in the financial statement presentation, and then conclude whether or not the organization has the ability to continue as a going concern over a period of time of greater than a year. That's different steps of the audit process. Reviewing the modified cash basis of accounting has the same type of report, except for the fact that it's on a different basis of accounting, and that's emphasized in an emphasis of a matter paragraph. Once again, in an audit process, the organization would be required to sign a letter of representation. The CPA needs to be independent, once again, in an audit process, as opposed to a compilation process. A significant amount of time is spent in the audit process gaining an understanding of the internal control structure, its environment. We do what's called walkthroughs of key areas of the audit, meaning the billing process, the payroll process, the bill paying process. We sit down with the members of the organization and walk through a transaction, determine how that process occurs, and what the process is. We document that and use that information to help us plan the audit. We have inquiries with various members during the course of the audit, whether it's management, staff, and also those charged with governance, asking specific questions about where the areas of risk are. Usually on a nonprofit audit, we assess control risk, the risk of materially misstatement at the maximum. Therefore, we, instead of doing tests of internal controls, we use substantive tests to conclude the audit. Substantive tests are just substantiating the financial statement balances, which include, not limited to, sending confirmations to banks, investment companies, and lenders and funding sources, reviewing contracts, grants, awards for restrictions and satisfactions of restrictions. So a key thing for a nonprofit audit would be, many times you receive a restricted contribution, and it's one thing to audit that money coming in, but also a key point would be auditing how that money is used and whether it's used for a specific purpose. We do predictive tests and tests to substantiate the revenue, payroll, and key expenses. We also, part of the audit process would be to determine if there's an equitable allocation of indirect costs. So indirect costs could be an administrative cost, could be occupancy cost. If you're a nonprofit that has multiple programs and you have different cost centers for those programs, it's important that those programs get an equitable allocation of the admin costs and occupancy costs in order for you to get a true picture of what that program bottom line looks like. You could have a surplus in that cost center before you allocate the administrative costs, but once you allocate the administrative costs to that cost center, that will give you a true picture of the financial results of a particular program. We also, during an audit process, we conduct a search of unrecorded liabilities, because it's important to, on an accrual basis audit, to make sure all the accrued payroll, all the payables, all the other liabilities are recognized in the financial statements for them to be, in order for them to be without material misstatement. So a search for unrecorded liabilities is part of the process, and a couple steps in that regard would be to review the minutes of the organization to understand the operations and to understand what some of the issues are, both during the audit period but also after the audit period, before we issue the audit. Another step of the audit process would be to send a legal rep letter to the attorney of the organization, and they would send a letter back to us indicating whether or not there are any legal issues that need to be communicated in the audit. An example of that would be if there's a pending litigation that the organization has that could potentially rise to the level of a contingent liability, it would be necessary to have that included in the audit as well. So concluding the audit process, we go through our test and we would propose audit adjustments. And if there's any audit adjustments, we'd get approval from management related to that. You would draft the financial statements and review the presentation with management. And then you would communicate any significant audit findings and internal control related matters to the board. You will also sit down and present the audit to the board, and a lot of times that's it's done at a monthly or quarterly board meeting, and before the audit is issued, that presentation would occur, because once again, these are your financial statements. Our responsibility would put a report on those financial statements, whether that's an audit report providing an opinion, or whether it's a review report, providing the assurance that a review report provides. There's certain ways to make a compilation review or an audit process more efficient and to minimize those costs. One would be to create a system that provides timely and accurate financial reports to the board. Another way would be to have a monthly balance sheet reconciliation process that's conducted by the organization. What I mean by that is, on a monthly basis, whether it's the accountant, whether it's if you're a large organization, a CFO or controller, going down the balance sheet and reconciling each balance sheet account and making sure there's sufficient backup for that. Another step of the process would be to adopt an annual budget of the revenues and expenses and providing a budget to actual comparison. That's such an important monitoring tool for an organization, to have a good budget in place. And, that's something that's utilized by both the board, but also the auditor in the audit process. It's important to structure your accounting system to mirror the presentation in the 990, because on page 10 of the 990, there's a statement of functional expenses. And, that is really a key form page of the 990 that's used by a lot of individuals. And it has the program activity column, but it also has the supportive activity columns, the management in general and the fundraising activity column. Those should mirror the audit, the financial statements, but then those should also mirror the financial setup in your accounting system. So I'm sure many of the organizations have multiple programs, and they set up classes and departments for each program and supportive services. And that helps you with the presentation of both the audit, but also the 990. And it's also, like I mentioned before, important to allocate those costs, those admin costs, to those programs so you can get an accurate evaluation of the program results. And another key item is it's important to set up as many internal controls as possible, as feasible, to segregate duties and create ways to reduce risk in the organization. If you don't have a large enough organization that allows you to segregate those duties, you can create ways to mitigate that condition by utilizing the executive director or your board of directors to perform certain functions. But it is definitely important to strengthen your internal controls as much as possible, keeping in mind, the cost related to that as well. I'm often asked, what are the costs related of these three different types of engagements, compilations, review, and audit? Just a rule of thumb that I've used over the years is like a review generally costs, a review would generally cost twice as much of what a compilation would cost, and an audit would generally cost twice as much as what a review would cost. There's so many factors related to, what, how much these different engagements would cost, but some key factors relate to the number of programs you have, the number of employees you have, what type of assets you have. Do you have investments? Do you have long-term debt? Do you have significant amount of fixed assets? Those are all areas of the audit that have to be considered. Other things, there's other factors that your board of directors may require you to have an audit, even if there aren't external factors. And as being on a board of directors, you have to have confidence in the organization and the information you're receiving. So these types of engagements, whether it's a review engagement or an audit engagement, do provide an additional level of assurance on your financial statements. So the purely following the BCO 10 requirements, isn't necessarily always the right way to go. There's always, different factors that involved, but I think the thresholds are significantly higher than what a lot of organizations use. There's plenty of organizations that have either reviews or audits done, but haven't met those thresholds. I know that I can think of many examples of reasons why that's necessary. We talked about different contracts having requirements. We talked about funding sources. Organizations have restricted money from various different sources. It's important that you track those because your fiduciary responsibility for that money, whether it's coming from a third party or whether you're maintaining that money and passing it on to somebody else, those controls that you put in place are important. And an additional step of providing accurate and timely financial statements, whether the financial statements are reviewed or audited, is also an important factor as well. Not sure if there's any questions, Joanne, that I could answer. Anything else?
Yes, you are generating some questions. So if you want to take a moment, one question is in-kind donations. Are they considered income, or how is that explained?
Yes, in-kind donations are part of that calculation. Okay, so when you look at that calculation of the total gross contributions, they are utilizing this Part 8 statement of revenue on the 990, and in-kind contributions are included in that number as well.
Line G.
So it's not part of line G. So line G is not including that total.
Okay.
So to correct myself, that would not be part of the calculation for that threshold. We're purely using A, B, C, D, and F, and not including the non-cash contributions. So, and here's an important note about in-kind contributions. So there's a lot of organizations have a lot of volunteers to provide a lot of different support. So,
right.
And from an accounting standpoint, that gets recognized. In-kind services gets recognized in an audit if it's a specialized service, and not necessarily the services that the organization of all the volunteers that are providing support to the organization. If it's something that's specialized and it's something that you would otherwise would have purchased if it wasn't donated, it gets recognized as an in-kind service. But non-cash contributions outside of services, also would always get recognized, and it ends up on this line 1G, and it would not be part of the total of that calculation. So it would purely be the type of money that comes in. And I guess that's also from the standpoint of a lot of smaller organizations, aren't necessarily recognizing those in-kind contributions as the larger organizations do.
Right.
Okay.
So, and then the next question is, what do you consider a large amount of restricted funds, which would constitute a recommendation for an audit?
So, I would consider if that contribution is over $200,000, $300,000, I think, but it also depends on what the use of that money is for. Like, if it is a $300,000 grant that is for a specific purpose that is easy to track, then that would be a different circumstance than if it's a $300,000 restricted contribution that's used for a program that there's multiple expenses that make up that $300,000. And so I think the preponderance of the information would be necessary for you to make that determination. But a lot of restricted contributions are satisfied within the same period of time. But if it stretches out over multiple fiscal years, you have to track that in a manner that in your financial statements, you're showing net assets with restrictions at the end of the year. And, that would make it more of a circumstance where you would consider having an audit on that restricted funds.
So what you're really saying is it has to be personalized to the organization and what the funds were committed for.
Yes.
Mhm. Does the process change for an all-volunteer organization without any employees?
So all volunteer organization without any employees, if you're, it doesn't change at all from the BCO's perspective. If you're getting over these thresholds, you're required to have either a compilation, a review, or an audit, despite the fact that it's all a volunteer organization. All volunteer organizations are very difficult to audit if you would happen to have that type of volume of activity. It could happen that you could have over that threshold and still be an all volunteer organization. But the thing about that is it's very difficult to set up an internal control structure and with an all volunteer organization and have the structure in place that permits you to have an audit done. But it doesn't necessarily, there is no distinction between whether it's an all volunteer organization or you have employees in the eyes of the BCO. In some respects, and if I'm a board member on an organization that's an all volunteer organization, I would prefer to have more of an engagement. I'd rather have a review or an audit done if you have the funds to do that, because of the fact that you don't have the structure in place, the internal control structure in place that you otherwise would if you had employees in place, and able to segregate those duties, because you have so many people in that circumstance wearing different hats, and all well intended, of course, but there's additional risk in that type of setup. Okay.
So, Gary, do you have any best practices for nonprofits that are smaller and what they should be in preparation for either a compilation, review, or audit?
Yeah, I definitely would recommend that, first of all, they have a solid budget in place. They annually adopt a budget, okay, and practices from the standpoint of having a set internal control structure where they identify who does what the responsibilities are, and have a segregation of duties to whatever degree they can establish, put whatever types of controls they can to assure that the funds are being utilized for the intended purposes. And a small organization, it would always depend on how many different programs they have. So a lot of times these small nonprofits start out with one program, and that program provides a specific function, but then it expands to the point where they have multiple programs, and you have to increase the reporting requirements there and separate those costs in a manner that you're able to track those costs. Also, a key factor would be to just come up with a standard set of reports that you're able to provide the board on a regular basis in order to track and make important decisions about the organization. Because it's a key would be just to understand in a timely manner, your financial results, and then react in such a manner as necessary.
Okay, great. Is there any other questions? If somebody wants to unmute themselves and ask a question.
I have a question about, you mentioned monthly review of financial statements. We have a CPA that handles our finances, and we have decided only to give the board quarterly reports, even though their monthly reviews. Does that cause any concern?
Not necessarily. I mean, so are you saying that the board meets quarterly and that they're getting quarterly reports?
We meet monthly. We're considering going to quarterly.
Okay.
And we had been getting monthly financial reports, but we wanted to move to quarterly financial reports, even though our treasurer is doing reviews monthly.
Yeah, I can certainly see many circumstances where the treasurer is reviewing those monthly, but they're not providing the full reports to the board until at the end of the quarter. Depending on the size of the organization, I think that would be adequate. A lot of times you're at this mercy of the volunteers of the organization, and if you're finding that a monthly meeting is not necessarily being well attended, if you reduce it to quarterly, you can get much more better attendance and get more accomplished if the majority of your board is active on a quarterly basis, as opposed to a smaller subset of your organization there on a monthly basis. But I do like the idea that you still have a treasurer that's reviewing those monthly and presenting those to the board on a quarterly basis.
So no issues in doing that if you decide to have an audit?
No. So if I was auditing an organization that had, previously had monthly meetings, but they switched to quarterly meetings, I would ask the question and you answered the question, what happens? Is there any type of steps that are taken on a monthly basis? And the fact that you have a treasurer that is continuing to monitor that on a monthly basis, I would find that adequate, as long as the quarterly meetings are well attended and the board's well informed. And more importantly than anything else is how accurate are the reports at the end of the quarter when you're getting those quarterly reports. And the way you're able to tell if they're accurate or not is at the end of the process, if you have an audit done, are there substantial audit adjustments that are necessary? Because my key thing when I do audits is, when we propose audit adjustments that are necessary, I have to communicate that to the board. And when we look at the final audited financial statements, is there a substantial difference between what our final audit report is for the year versus what the organization has, the board has seen throughout the year? And if there is, then there's a weakness in your internal controls, and changes need to be made. But if you have quarterly meetings and at the end of the year you have an audit done, and the last financial statements at the end of the year isn't substantially different than what the actual audit report is showing, that tells you that the reports were accurate and timely, even if they are on a quarterly basis, and sufficient to allow the organization to be monitored, in a manner that's necessary for a nonprofit.
One of the things we've been talking here at the foundation is about nonprofits being trustworthy organizations, and that this whole process, Gary, I don't know if you agree with me, but with compilations, reviews, and audits, is a level of transparency that when funders are looking at organizational documents, that they can see an accurate picture of what is going on.
Yeah, I agree with that. And that's extremely important. As if you're sitting on the board of a nonprofit, what you're putting out there as representing the financial position and results of your organization has to be reliable and relied upon in order for the public to have the confidence to consider contributing to your organization. So that's why, like, when we looked at the compilation report, the compilation report comes right out and says that it's not providing any assurance. So I've had a lot of I've had organizations in the past say, yeah, okay, we're going to go with a compilation, but I always make sure they understand what the end result's going to be, what the report's going to show. And then sometimes they take a look at that and say, well, that's not what I'm looking for. I want to step up the engagement to a review engagement, because at the end of the day, when we publish these reports, we want some level of confidence that the financial statements don't have any material misstatements in them, and they're accurate financial statements. So I agree with you, Joanne.
And if you're taking the time and effort and finances to go through this process, you want to make sure that it's accurate.
Yeah,
for any of those levels.
Yeah,
particularly
absolutely.
review and audit.
So another key point is, obviously the 990 is such a key document for a nonprofit organization, and it's a public document, and a lot of your funders, a lot of your donors have the opportunity to review that, and that's your opportunity to present your accomplishments, but also present the financial position of the organization, and that has to be consistent with any type of report that you provide. If you have an audit or review done, those two, as a matter of fact, there's a form, a page on the 990 that has a reconciliation of the 990 information to those audited financial statements, or the reviewed financial statements. If it's a compilation, that's not necessarily something that always is easily reconciled between the two. They should, but the compilation without having the level of assurance, it doesn't necessarily always match up exactly with the 990, and that's something that could cause some questions with the organization as well.
Yes. We got another question, Gary, and it says, I'm sure it can vary. What is the general cost range for a review or audit? I think you touched on this with doubling.
Yeah, I mean, and it's tough to say what the cost, but I'll just give you just a simple example. If there's an organization that has a compilation done, part of that process, now keep in mind, it depends on if I'm handed a set of financial statements and I'm doing a compilation, but in most instances, a small organization asks us to do a compilation. We're actually doing financial statements and preparing the notes to the financial statements as well, to make them in accordance with generally accepted accounting principles. But and also we're also doing the 990 as well in a lot of instances. So you're doing really 3 steps. You're doing a compilation, you're doing the financial statement preparation, and the 990. But I can give you an example. If it costs $2,000 to do a compilation, it might cost that organization $4,000 to have a review and $8,000 to have an audit. That's kind of what I would, and that's purely basing it on what the organization, a simple organization without a whole lot of other programs. But when you start having multiple programs, when you start having a balance sheet that has investments, debt on the books, and things of that nature, there's more time and effort to audit those types of organizations.
And also, sometimes is it included that the filing for the BCO is also included?
Yes, that's generally that generally goes hand in hand with the preparation of the 990. So when you submit the BCO 10 to the Bureau of Charitable Organizations, it has both a 990 that's attached to it, but also the type of report that you're required to submit with it as well. So the submission to the BCO 10 has the 990, but also has either the audit review or the compilation that has to be attached. But yeah, there's plenty of small organizations that are below that threshold that are simply just hitting print from their accounting software and providing that internally prepared financial statements. And that's sufficient for the BCO purposes. But if you're going out and trying to get a grant or trying to raise money in a lot of different manners, it's more appropriate to have a professional financial statement prepared.
Right. And if there's anything else,
I have another question about the periodicity of, if you start by doing an audit, what's the expectation in subsequent years? Can you do an audit one year do reviews for 4 years, do an audit again? Do you wait 10 years?
You could, I mean, you know, so the thing about when you look at the financial statements should look the same whether you're having a compilation review or an audit. What's different is the report that's being provided, the accountant's report that's being attached to it. And that accountant's report, you know, provides what level of assurance that you can provide on those financial statements. So the preparation of the financial statements could be the same, but the level of engagement can change based on what your needs are. And I understand what you may be asking is that what's the perception if you have an audit 1 year and then you reduce it to a review in a subsequent year? You know, and that's a fair question. I have had circumstances where organizations have audits 1 year and every other, and 2 years after that, they have 2 years of reviews and the third year of an audit, or that's acceptable if you don't have any external requirements that require you to have an audit performed. And once again, if you're not hitting the threshold that the BCO is requiring you to have.
All right. Well, thank you for this dialogue, and Gary, for your insight and time on this very important subject matter for nonprofits, and to get into the practice of what's right for their organization in terms of financial responsibility. The next session in our Nonprofit Leadership and Engagements Education Series will be Tuesday, February 27th, and will be Winning Grant Proposals Part 2. It will be presented by Jennifer Reitzel, PNC Charitable Trust, Lori Fink of the Hillman Family Foundations, Shani Layson from the FISA Foundation, and John Pro from the Pennsylvania Department of Community and Economic Development. Look for a registration e-blast in the coming weeks. Thanks again for participating in this session today, and I hope you have a wonderful day and a fabulous holiday season.